Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. This week culminates in the latest US jobs report, which takes place on Friday, the 6th of September. And if last month is anything to go by, we could see some serious volatility when it comes to both markets, but also expectations around the Federal Reserve. So in terms of expectations, here's the breakdown according to Trading Economics. You can see here non-farm payrolls expected to move moderately higher up to 120k, up from 114, but both of them relatively lowly figures. Now that unemployment rate number is going to be absolutely crucial this time around. And that's because last month we saw a rebound from 4.1 up to 4.3. That surge in unemployment had people calling for a potential recession. And so whether we see a continuation of that or whether we see unemployment actually decline, that should really give markets an idea of whether the possibility that we're going to see a big resurgence, a big surge in terms of unemployment is going to happen, or whether people have got a little bit carried away with themselves. Now, of course, average hourly earnings is another element to be factoring in. Wage costs are an underlying factor that should push up inflation if they're elevated, or if we see them continue to drop, then it really does make people feel confident that the Federal Reserve will be able to cut rates if and when they please because of the diminishing factor that is above target inflation. 3.6 expected to remain at that level as things stand. I've got a whole host of charts to show you, so let's breeze through them. First and foremost, here's an overview for some of those big figures. You can see that we're seeing normalization for some of these. Most notably, we're seeing participation rate, non-farm payrolls, are roughly around the kind of areas that we were seeing pre-pandemic. The difference here is that we're actually seeing an uptick in terms of the unemployment rate. So whether this is the beginning of a significant move higher for unemployment, that's going to be absolutely key. Part of that is this so-called Sam's rule. Now, you can see on the next slide, it highlights exactly what this is. And you can see it at the bottom here that essentially it's calculated when the difference between the 3-month and the lowest 3-month average of the unemployment rate moves higher by 0.5%. Now, if we're looking at the breakdown for historical moments where it has been triggered, you can see that each time it has called a recession. So the fact that we're now above that 0.5 mark, which is essentially 0.53, that points towards a possible recession coming into play. And so you can see here in terms of the breakdown for each of those previous occasions that it could be different here. And part of that is because we've got the initial jobless claims that are still relatively low. Now, I'll show you the breakdown in terms of the initial jobless claims. But from a historical perspective, despite the fact that they have been picking up and that's been grabbing some of the headlines, it's not necessarily massive numbers that we're seeing here. So 238 on that initial jobless claims. And you can see previous occasions significantly above that. You can see March 1970, you'd have to go all the way back there to point towards a moment where the Sahm rule was triggered, but that we saw initial jobless claims in the 200s. So the question mark here is, has this rule that suddenly is hitting the market that everyone says is going to indicate a recession coming into play, is it different this time around, or will we see a recession going forward? Well, it's worth noting that we have, of course, recently seen the latest revision to the GDP figure for Q2 that was annualized out at 3%. And there's an expectation that the third quarter will also see a strong number as well, perhaps below that 3%, but not necessarily seeing that number actually dropping into negative territory. So here's a few different elements to look at when we're looking at unemployment in particular. You can see here that with the job openings figure, this is the JOLTS number, and that is released on Wednesday. The JOLTS number has been moving towards the downside in terms of job openings. And then I also divided the people that are quitting versus against the people that are having laid off or discharged. Well, obviously, if you're quitting, you're feeling a lot more confident about the jobs market compared to if you're being laid off, which of course is generally not necessarily something that's voluntary. And whilst it has picked up somewhat, you can see there is a downward trajectory. So less people quitting relative to people being laid off. And that really overlays well with the whole job openings decline. So these three lines should relatively move in tandem, and generally it's been that sort of job openings and then the quits first layoffs that has been declining ahead of that unemployment rate. But the unemployment rate is rolling over gradually here. You can see, of course, I've inverted that unemployment rate just so that you can overlay them well. But certainly these two metrics would point towards unemployment moving towards the upside. Now, this is a relatively zoomed in format of the initial jobless claims number, but we can see again the rise in terms of jobless claims, the rise in terms of continuing claims does generally go hand in hand with the unemployment rate. So we're gradually bottoming out for all of these metrics. It does highlight the importance of watching out for these different metrics. Initial and continuing jobless claims both released on a weekly basis. So when you're looking at those figures, understand that this is the kind of thing that feeds into what's happening in terms of that wider unemployment rate that we see once a month. And then the conference board, hard to find versus plentiful. So if you divide those that find jobs hard to find at the moment and those that find jobs plentiful, then you get a ratio that once again you can overlay with the unemployment rate. It gives you an idea, a leading indicator of how people on the ground are feeling within the jobs market. And you can see here it tallies up pretty well. Sometimes you see it running ahead of things, and on this occasion that appears to be the case. We've seen it sort of rebounding at times when the unemployment rate hadn't really been doing so, but now we're seeing unemployment up above that 4% mark and gathering momentum. And it appears to be moving in that upward trajectory, much like that ratio between those that find it hard to find jobs, hard to find, versus finding jobs plentiful. And you can see as time goes on at the moment, more people are progressively finding it difficult to find a job in the US. And that's starting to translate into unemployment because, you know, these are the kind of things you see, some of these sort of softer metrics that generally you might see or start to see the turning point ahead of some of those big numbers themselves. In terms of the payrolls numbers, this is an important chart. So this essentially highlights the difference between the initial payrolls number and what it ultimately turns out to be. So we get revisions down the line, and some of these revisions have been absolutely massive. And so we can see that here with this big sort of area of red on the right. Those are all downward revisions. So we've seen in the past upward revisions on the left-hand side, 2021, 2020. And now we're seeing those downward revisions. It means that some of those numbers in the past that we've been following and say, well, the US economy is doing pretty well. If you look at the strength of those payrolls numbers, well, a lot of them can't be trusted because we've seen them dramatically downgraded at 818,000 jobs between the year to March that have been essentially eradicated from the numbers. This is another way of looking at that disparity that we've seen historically between the final and the initial numbers. So I've essentially put this together, and you can see on the right-hand side that we've really seen a significant sway towards the final numbers being significantly lower. So this again feeds into the idea that the US economy isn't doing as well as we thought it had been previously, because we're seeing some pretty hefty downward revisions, 97K, 67K. So big downward revisions taking place. And you can see that really over sort of year by year basis, we are used to downward revisions. And you can see that has taken place through 4 out of the past 5 years. But this year, things have been taking a turn, and we're seeing such massive downward revisions that you can see here. We're seeing this year the biggest downward revision to payroll since the global financial crisis as things stand. This week also, of course, sees another bunch of metrics, one of which is going to be the ADP payrolls number. And generally, if you were to go onto Twitter and you look for any commentary around this ADP payrolls number, you're just going to get a lot of people saying it's irrelevant when it comes to Friday's jobs report. And often it is, quite frankly. You know, maybe it will tell you the direction of travel, but in terms of telling you the absolute number, it's generally not particularly that useful. But we can see here that along the bottom, there is a narrowing when it comes to the final reading rather than the initial. So essentially, if you're looking at how the figures have fared versus ADP versus non-farm payrolls, the final figure generally plays out a little bit better, a little bit closer to the ADP number. So it may mean that essentially when you're looking at the ADP figure, it's not going to be that close to the payrolls number. But once you get it revised, they will likely be somewhat closer. That's how it has been playing out recently. So maybe the ADP is a better indicator of the payrolls number than the payrolls number itself, than the initial one, right? But it's difficult because ultimately, we're talking about trading, and markets trade around the release. They're not going to trade around, the numbers come out at 300K, but, we could find out in 4 months' time that actually it should have been 200K. They will trade the announcement as it is. So the fact of the matter is that the relationship between the ADP payrolls and that initial non-farm payrolls figure has been pretty far off at times, quite frankly. So it's not necessarily hugely useful. In terms of the average hourly earnings figure, you can see here there's a close correlation between average hourly earnings and core CPI. So like I said, if we're seeing downside in terms of average hourly earnings, you're talking about the downside for essentially an inflation proxy. And so that makes people feel more confident that we are going to be able to see the Federal Reserve cutting rates in a dramatic fashion. You can see in terms of the 3-month annualized wage growth figure. So essentially, how have things been tracking over the past 3 months? And you look at where we were previously, say pre-pandemic, we're back into this zone that I've drawn in that gray shaded area. So we are at the top end of it, but we are certainly getting back into an area of relative normalization when it comes to wages. Remember, that 2% target is relevant for inflation. It's not necessarily relevant when it comes to average hourly earnings. And so whilst we do currently see average hourly earnings at 3.63, and so of course it's well above where that 2% target is for inflation, that's not necessarily a problem. You can see that 3-month annualized figure shows you that recently we have got back into that shaded zone. Certainly further downside, though, would give us greater confidence that the Federal Reserve are going to feel confident and feel emboldened behind the idea that we will be able to see them cut rates in a significant fashion going forward. And that brings us on to the outlook for interest rate cuts. Now, generally, I'll just look at the next one first. So first and foremost, you can see 65% at the top right, 65% chance that we see a 25 basis point cut, 35% chance that we see a 50 basis point cut. And so what's notable over the past month, and bearing in mind a month ago was when we had seen the US jobs report, and markets were pretty shocked, quite frankly, in particular around what had happened in terms of unemployment. And so what we saw at the time was really strong confidence that we're going to see a raft of rate cuts, right? So we're talking about the base case scenario being that we move back down to 400 to 425. That means 125 basis points worth of cuts. That's where we were a month ago in the aftermath of last month's jobs report. But things have changed since then, and there's some normalization that has been taking place. And instead, now we're looking more towards 100 basis points. That still means that in 3 meetings, we're going to need one of them that's going to be a 50 basis point cut. By and large, people are looking more towards the next meeting. So we can see here that we've got 65% chance for 25 basis point move. But then if you're looking towards the next meeting in November, 68% chance that we see that 50 basis point move then, and then 92% chance that we end up at the end of the year 100 basis points lower at 425 to 4.5. So the question mark here is, how are we potentially going to shift around this announcement? And so we already have got a blueprint or an outline for how things played out previously. What happened last time? Well, we saw a significant uptick in terms of unemployment. And so if we see further weakness in terms of the jobs market, so weak payrolls, if we see another move higher in terms of unemployment, you're looking towards the possibility of further downside in terms of the Treasury yield, further expectations of interest rate cuts from the Federal Reserve. And we'll look at how markets might respond to that. So first and foremost, I'll bring up the chart for the dollar index. Let me just get that up. So the dollar index is essentially an idea of where we think the US dollar might move, right? And so whether you trade the dollar index or whether you trade euro dollar or, you name it, The fact of the matter is that the dollar index can give you an idea of where the dollar is trading, and then you essentially pick the other side of that trade if you're trading a pair rather than the index. So what's notable here is that we can see here with the purple line here, pinky purple, that we have a very close relationship between the US 10-year yield and the dollar index. And so if we look at this blue line back here, this is where we saw this sharp move towards the downside in terms of the US 10-year yield, and we saw sharp declines in terms of the US dollar as well. And that came at the time where we saw that uptick in terms of unemployment. So it stands to reason that if this time around we see unemployment move towards the upside, we see payrolls moving lower, those kind of things happening, then we would see a similar kind of thing, right? We'd see weakness in terms of the US dollar. We'd see weakness in terms of the US 10-year yield. Now, quite frankly, I should have probably put the dollar index on first because US 10-year, because then we'll be able to look at it from a charting perspective. So that's that. We know that if the data comes in weak in terms of the payrolls and the unemployment rate, if it points towards economic weakness, we're talking about potential downside in terms of yields, because we're talking about the possibility of maybe 125 basis point cut comes back on board. And so you're looking at the possibility of weakness in terms of the US dollar. If we see the opposite, if we see economic strength coming into play here, then we're likely going to see further trimming in terms of those expectations for interest rate cuts. Maybe it's just 75 basis point cut worth of cut this year. And therefore you're talking towards or talking about potential for higher yields, potential for higher US dollar. So as we see here, we have been regaining some ground of late. The fact of the matter is that we're stuck within a downtrend as things stand, certainly evident here on the daily time frame. I can show you on the weekly as well, just to give you a wider context. It is notable that we are around this area of support down below. Let me just grab some of these lows. So we've got that area and zone of support around about your 100 mark, right? And so we've seen a rebound coming off the back of a period of 1, 2, 3, 4. So essentially 3 out of the last 4 weeks have seen really significant downside for the US dollar. Will we see those risks allayed? Will we see a stronger US dollar coming into play? Well, certainly some people have been calling for that unemployment rate to be written off as something that's been impacted by temporary measures, weather and the like over in the US. And if that happens to drive unemployment back down to say 4.2, that could provide upside here for the US dollar. For the near term, we can see here that we've got this sort of upward trajectory in terms of price action. And so it's just this stepped move higher. That means that we're looking out for a breakdown through the price swing low as things stand. That's to 101.5. For things to start looking a little bit more bearish once again. And then if you look at this wider context, you can see that the gains that we're seeing at the moment fall within the realms of a retracement as things stand. Certainly as we've broken up through your first area of resistance or your first swing high around, there we go, up here. Because we've broken that 101.625, it does point towards a possibility of further upside coming into play for the near term. But like I said, we've got data coming out over the course of the week, whether it's the JOLTS job openings data, whether it's jobless claims or the ADP payrolls number. And then we've got this figure coming out on, or these figures coming out on Friday. They're all going to play into this sentiment. But generally, if we see a weak economic data point, I think there's a good chance that we do see a downside in terms of yields, downside in terms of the US dollar. And then looking at the S&P 500. So the S&P 500, if you're looking at it in isolation, it looks great, right? It keeps going up. And so recently it's looking like it's kind of asking questions back at these prior record highs, right? We're selling off. I'm recording this on Tuesday. We're selling off and heading back down towards this key support level 5561. If we break below that, you know, is this a top? Maybe it's just the beginning of a retracement phase. We don't know exactly how far that retracement goes. So if we're talking about how does it react to shifting expectations for interest rates, we'll overlay that US 10-year yield, right? Because as we saw with the US dollar, this is the kind of thing that not only reflects the relationship between market expectations in terms of the interest rates, but also reflects in on the US dollar, and so has an impact on markets. And so if I overlay, there we go, if I overlay that US 10-year yield, we can see here that it's pretty messy. There's periods where higher yields actually lead the market higher. There's periods where the decline in terms of yields weakens the market. So you could say, oh, we're declining in terms of yields. That could come because of economic weakness, right? If we're thinking that we're going to get a recession, then it's not a given that equity markets are going to decline, because one side, you could see equity markets declining because they think, well, a recession is bad for businesses, and so the underlying stocks are going to struggle to have strong earnings growth. And the flip side of it, we're likely to see more interest rate cuts from the Federal Reserve. And so, we also see the market recovering during periods of downside in terms of the treasury yields. And of course, the beginning of last month, it was the 5th back here, we saw an initial sell-off, and then we've seen that rally coming into play despite the fact the yields are moving lower. So what can we glean from this? Well, we can also look at relationships or ratios. So let me see if I can hide this. I think it's on here. There we go. So let's hide the initial one. And then we're going to look at the DAX as a ratio against the S&P 500 and the FTSE 100 as a ratio against the S&P 500. And so what does this tell us, right? Because we have a much closer relationship here with the 10-year yield and those European markets against the S&P 500. That means that essentially the S&P 500 is expected to outperform at times where we're seeing yields declining, the US 10-year yield declining, but underperform at times where we're seeing the US 10-year yield rising. And so it essentially means if we think we're going to see more rate cuts from the Fed, we're likely to see US markets outperform. And that comes when markets are on the way up and on the way down. But if we think that we're going to see less rate cuts from the Federal Reserve, and so we see higher yields, then we're likely to see outperformance closer to home here in Europe. So that ratio and relationship should give you an idea of how we may react on a relative term. But when you're looking at price action for the S&P 500 itself, generally it can go one of two ways when it comes to movements in terms of the US 10-year and in terms of market expectations for interest rate cuts. Because of course, if we see sharp moves lower in terms of inflation, yeah, that's great. That's the kind of thing that we think we can get more rate cuts, but it's not necessarily going to impact businesses. But if we're seeing at a time where we're seeing recession fears driving its expectations of more rate cuts, then it's not necessarily as clear cut when it comes to how businesses should react, or the price of businesses, the value of businesses. And on this occasion, we're talking about the potential for weakness in terms of the jobs market. We're talking about weakness in terms of the economy and a potential recession. And so if we see weakness this time around, it's not a given that a decline in terms of the economy, a decline in terms of the job numbers should lift stocks just because of the fact that it lifts expectations in terms of additional rate cuts from the Federal Reserve. And so price action is going to be key here. Like I said, we've already got that line drawn onto the downside, 55.61, a break through that level. By the time we release this, it might have already broken through that level. If that happens, then we're looking at a potential retracement phase coming into play. I don't think this is the beginning of some huge top. We are on the cusp of a series of rate cuts across the world and across the Western world. And so, yeah, near-term weakness, that would likely be perceived as a retracement. And certainly you can see from the bottom end of here, we've got these higher lows coming into play. So that's going to be key if we break through support. But certainly if you're looking at that relationship, it's going to be more clear cut when it comes to the US dollar, less clear cut as to what's going to happen in terms of equity markets. But then the US dollar doesn't have the same kind of trend as equity markets, because equities in the US just go up over time. We do have blips within that. I hope this has helped. It's going to be a particularly important jobs report. There have been plenty of times in the past where we've looked at the jobs data and said, we're going to see volatility, but it doesn't actually come to fruition. And it comes at a time where markets don't really care that much. Markets care right now. This is going to be absolutely key. And it's going to shape all the conversations that we will have going forward around the possibility of a recession, about the Sahm rule, about, whether the Federal Reserve is going to be acting too late and they need to start sort of front loading their interest rate cuts. Certainly if we see weak economic data once again here, it does bolden the doves and raise the expectations for a potential 50 basis point cut from the Federal Reserve this month.